Okay, we are back, part 4. Got a fresh cup of coffee, so I am ready to go. So part 4, stocks and valuation, chapter 9. Okay, this is the final section of this chapter, and we should be done. So again, we're still with the non-constant growth. Okay, to summarize, it's a company that grows, at 20% or 30% for a couple of years up front, and then subsequently levels off at, for example, maybe 5% thereafter. Okay, so we're up to this point. We've calculated all the dividends. We found the horizon point. We got the price at the horizon point, and now we have all the cash flows. D0, D1, D2, D3. The first price at D1, dividend 1, is $1.50. D2 is $39.60. And of course, D0 was the starting point. So if we take each of those cash flows and plug them into your cash flow statement calculator, D0 is going to be 0. Okay, there's nothing there. D1 will be $1.50. Cash flow D2, remember, is $39.60, which is the dividend amount and the price at P2. So we added those two together. And here, the 10% is the R value. Okay, that is used in lieu of interest. Okay, so the 10% required is put into your calculator where the interest. So put that in your calculator at 10%. That brings you back to $34.09. So that is what we were ultimately looking for. That is your intrinsic value at P0, $34.09. So for example, if someone had that stock and they wanted to sell it to you for today at $50, for example, if you ran those numbers through the model, you would come up with a true value of $34.09 and tell that person he's charging you too much. Okay, so again, that is the intrinsic value really from the first couple days in this class. Okay. Now keep in mind, this concept can be used to find intrinsic value of the whole firm. Okay, that is showing up in problem 9.5. Okay, so the intrinsic value of the entire firm, that amount is equivalent to, in the problem, is equivalent to the dividend. Okay, a constant amount. Okay, really the last couple things here in this chapter. Preferred stock, okay, really is a hybrid of a stock and a bond. So we're given this pretty simple formula. The value of the preferred stock is its dividend over the rate. So for example, if we look at, put this on here for a second, if this were treated like a bond, it might have a face value of $100, annual payment of $12. Okay, so those are the numbers that we're looking at. That's the value, that's the face value. Dividend at $12 is what you're getting each year. Okay, and with an expected return of 12%. So $12 over 12% gives us a value of $100. Okay, if we want to write that sort of in a different format, we can come up with any one of these three variables. Of course, if you're given the other two. So here are some definitions. D designates the annual dividend paid. R is the required return. Remember, if it has that hat on it, R hat, that would be the expected. So, but here it's required. V is the value. Okay, so again, we just reorganized the previous problem. Here is your face value, 100 bucks. It's going to pay $12 per year as a dividend. So 12 bucks over the value, that tells us it's a 12% return. So R is 12%. Okay, so previously we looked at it a little differently. We looked for the value based on the other two variables. Here we're given the other two variables, and now we gives us 12%. Okay, the last simple concept, we talked about this but in a different context, but the math works the same way. We want to find out what the dividend yield is in year one. Okay, very simple. Dividend yield is D1 because we are looking for the future, the year out. We kind of extrapolate out 1 year. If we know the price at PO, we're expecting dividend D1 over PO. That is our dividend yield. Likewise, if we want to come up with year 2, it's simply D2 over P1. Year 3 would be D3 over P2. Okay. We went over that with the stock. Remember the stock yield, same mathematical formula. Now we're looking for dividends. And okay, same way with the stock gains. The bond gains, the yield. Here we're looking for the capital gains at year 1. So that math formula is P1, that price out into the future 1 year, minus the base, PO, over the base. That will give you some percentage. If you want to find year 2, it's simply P2 minus P1 over P1. Okay, so if you wanted to put some numbers to this, if it went from P2 was 200, to exaggerate it, and P1 was 100, okay, 200 minus 100 is 100 over 100. That's your capital gains, okay, 100%. If it was at 100, it grew to 150. That's again exaggerated, but just to show the math, 150 minus 100 is 50. 50 over 100, okay, is 0.5, 50%. So 50% capital gains. And if we want to come up with the expected total return for that stock at year 1, we're simply adding the dividend yield plus the capital gains yield. Those two amounts, add those two together, and that's the full total return. And that is it. Thanks very much. See you next time.